So, how to calculate a capital gain. Have you been through this today? Okay. Well, then we're going to go through it kind of quickly. I've learned that with tax law, it takes me about 10 times to learn it. So this is what I found. I'm going to use the California example because in Ohio, we don't have very many million-dollar homes. But if you had a property that you paid $500,000 for and you sold it for $1 million, you would think your gain would be $500,000, right? Not quite correct. You have what's called a basis, and that's your purchase price of the home. That would be the $500,000. And then your basis gets adjusted by a couple of things. One, the investment that you made into the property by making repairs, that would be capital improvements, or $25,000. And then we all know that we have depreciation when we own real estate. How many of you understand how depreciation works? Okay, then I'm going to give you a brief example of what depreciation is. The government says our houses are a lot like this little clicker, that if I paid $27,000 for this clicker, that 1/10 of the, or 1% of the value of it over 27 and a half years goes away. And at the end of 27 and a half years, this clicker would have no value. Now, if I put it in a box and saved it and kept it clean and put new batteries in it, the clicker would still have value, right? Well, the government says that depreciation, or that 1/27th that you take away every year, is a loss, and it's an expense against your income. So although your property is increasing in value, because properties increase in value if you take care of them, the government allows you to write off 1/27th of that property every year as an expense. So when you're thinking about a $1,000 a month income or $12,000 a year, if you have a $100,000 property, you're probably going to be writing off about $3,000 in expenses for your depreciation. So that income is offset. And when you grasp hold of that, that's when real estate becomes even more attractive, because not all the income that you earn is actually taxable. So let's go back to our example. Now that I went off on a tangent. Your purchase price was $500,000. That depreciation in this example was $100,000, and we did $25,000 in repairs. So the adjusted basis is $425,000. So you're going to pay taxes on the difference of that adjusted basis and what you sell it for, or $575,000, right? So let's see how much tax that is. The depreciation recapture would be about $25,000. Your 15% federal capital gains tax would be $71,250. And in the great state of California, your state tax would be 9.3%, or you would be paying $53,000 in taxes, for a total of $149,000. So if you sold the house, just took the cash, you would pay, of your $575,000 you were putting in your pocket, you would give away $149,000 of it. Well, wouldn't it be nice to be able to keep that? You're going to be able to do that by doing that 1031 exchange, or exchanging into other properties. And this is how that works. You're going to save 29% in taxes by doing that exchange. Now, that's an exchange on a rental property into rental properties, is this example.